looking at a financial terminal right now, uh, it honestly feels like staring at a split-screen reality.
Oh, absolutely. It's jarring.
Yeah, right. So welcome to another deep dive. Today, we've got this massive stack of market analysis reports, brokerage notes, macroeconomic data just sitting right in front of us.
And it is a very thick stack today.
It is, yeah. And all of it is intensely focused on the Indian stock market, specifically, the NIFTY index as we sit here in late March 2026.
Right.
So the mission for you, our listener, is to basically cut through some truly deafening market noise. We're zeroing in on two really immediate questions. First, has this market actually exhausted its downside? Or, is this just a pause before another leg lower?
Which is the million-dollar question right now.
Exactly. And second, if we look past this immediate volatility, where do the top institutional desks actually think we'll end up by the close of 2026?
Yeah, and that's where the disconnect gets really interesting, because we aren't just looking at what the numbers are today. We want to understand why they are behaving this way.
Right.
And how you can use that framework to evaluate all this daily noise, because there is a striking divergence in sentiment right now.
There really is. I mean, if you just look at the ticker, there's this palpable fear, just broad-based sell-offs, portfolios bleeding red.
Yeah.
But then you flip to the back pages of these exact same analyst reports, and, well, global brokers are projecting record highs, like 28,500, even 29,300 by year-end.
It's a total paradox.
It is. So, okay, let's set the current scene. We are looking at data from March 27, 2026.
Right.
The Nifty closed around 22,819.6.
Right.
And with Indy VIX pushing nearly 26.80, so fear is high.
High is an understatement. That elevated VIX is it's crucial context for the listener to understand this 22,800 level.
Okay, unpack that a bit for us.
Sure. So when volatility premiums, the VIX, blow out to near 27, the market is essentially bracing for impact.
Like putting on a seatbelt.
Exactly. It tells us that traders are willing to overpay for downside protection because they think the probability of, sudden, sharp drops is unusually high. The fear remains very elevated.
Okay, let's unpack this then, because trying to find the absolute bottom of a market like this is often called, catching a falling knife.
A very dangerous game.
Right. You get cut. So
Yeah.
I have to ask, based on these reports, what does a true bottom actually look like? Is it just hitting the absolute lowest price point and then bouncing?
Well, no. The sources clarify that a true bottom isn't really just a low number. I mean, it's a process.
It's a process.
Yeah. It's not a clean V-shaped pivot. It's the point where selling pressure finally fails, support holds repeatedly, and the market actually starts reclaiming resistance. So right now, the reports note that the Nifty is in a, quote, bottoming zone rather than at a clean, confirmed bottom.
Got it. So what are the actual technical levels in this zone? Where's the battleground?
The primary battleground, the really crucial support band, is between 22,950 and 22,900.
But wait, the Nifty closed at 22,819, so it's already slipped below that, right?
Yes. Yes, it has. And that's why the anxiety is so high. Because if that primary band breaks definitively, we look down at 22,750.
Oh, wow. Or even a deeper flush to 22,500.
So what do the bulls need to do to prove the bottom is in?
To confirm a bottom, they don't just need to stop the bleeding. They have to actively reclaim 23,000
Okay.
and eventually power through the 23,500 to 23,600 zone. Until then, it's essentially guilty until proven innocent.
Right. So those are the lines on the chart. But technical lines only tell half the story, right?
Absolutely.
We have to look at what the actual Indian economy is doing to support these numbers. Because when we pivot to the macroeconomic data, the valuations, the divergence is just jarring.
It really is. The valuation check is a critical piece of data here.
Yeah, let's look at the Nifty PE ratio. The reports have it sitting right around 19.97.
Which is huge.
Yeah.
Because that puts the market in a fairly valued zone.
Meaning it's not a bubble.
Exactly. We're far away from an extreme euphoric bubble. And a PE just under 20 heavily supports the case for a medium-term base. It's a structural floor. And the economic engine under that floor is surprisingly strong.
Yeah.
I mean, looking at these sources, CPI inflation for February 2026 is totally contained at 3.21%.
Very comfortable.
Right. And because of that, the RBI has kept the repo rate steady at 5.25%. And then GDP growth is robust, estimated at 7.4% to 7.6% for the fiscal year.
With Q3 coming in at a whopping 7.8%.
Yeah. So wait, this is where I need to push back.
Go for it.
If the economy is growing at nearly 8% and inflation is, practically chilling, Why are we sweating over the market-breaking support levels? Like, why the massive disconnect between a pristine economy and a bleeding stock market?
Right, it seems contradictory. But if we connect this to the bigger picture, it makes perfect sense.
Okay, how so?
You have to separate structural economic gravity from short-term liquidity, those strong fundamentals, the 8% GDP that forms a macro safety net.
So it prevents, like, a total multi-year crash.
Exactly. It prevents a structural bear market. But in the short term, stock prices are incredibly vulnerable to sentiment, to liquidity flows, and external shocks.
External shocks.
Yeah. Even if the underlying domestic engine is a powerhouse, if it gets hit by an external shock, it's going to stumble.
Which perfectly tees up the next big question. What exactly are these external shocks that are causing such a massive drag on India right now?
The sources are very clear on this. The primary villain here is crude oil.
Oil, of course.
Yeah, geopolitical tensions in West Asia pushed Brent crude above the $100 mark during March 2026.
Over $100 a barrel.
Yes. And for the listener, let's connect the dots on why that's so dangerous.
Yeah, trace that domino effect for us.
Okay, so India imports a massive amount of its oil. So when oil spikes above $95 or $100, India's import bill just swells.
They suddenly need a lot more US dollars to buy that expensive oil.
Precisely. And that massive demand for dollars weakens the rupee.
Right. And when the rupee weakens.
It leads to imported inflation. Everything you buy from outside gets more expensive.
So that nice, cool 3.2% inflation rate we talked about is suddenly under threat.
Exactly. And when foreign investors, the FIIs, see that threat, they get spooked.
And they pull their money out.
They do. They hit the sell button on Indian equities to reduce their risk.
Which creates this massive tug-of-war in the market.
Right? A historic tug-of-war.
Because on one side, you have these aggressive foreign sellers, the FIIs, just dumping shares.
Right.
But on the other side, the domestic buyers, the DIIs, the mutual funds, the local retail investors, they are trying to step in and absorb all that supply.
Yeah, and that domestic bid is incredibly strong. But the sheer volume of selling creates immense friction. The market grinds down under the weight of it.
So for the listener who's watching this tug-of-war, how do they know when the storm is finally passing?
Well, the sources actually provide a really practical checklist to judge this. There are 4 things to watch.
Oh, a checklist. I love that. What's number 1?
First, we need to see that support holding, specifically around that 22,950 to 22,750 area. It needs to stop breaking.
Okay, support holds. What's number 2?
Second, the India VIX needs to peak and then fall definitively. The fear has to drain out of the options market.
Makes sense. Third,
the FIIs need to stop their aggressive selling. The outflows have to dry up.
and the final one.
Finally, the root cause crude oil needs to cool down, and the rupee needs to stabilize.
So support holds, VIX drops, FII selling stops, and oil cools.
Exactly. That's your bottom checklist.
Okay, so here's where it gets really interesting.
Yeah.
Because despite all this current doom and gloom, the $100 oil and the high VIX,
Yeah.
analysts looking at the end of 2026 are singing a surprisingly upbeat tune.
They really are. The year-end projections are incredibly constructive.
Let's run through these projections from the street for
Yeah.
the end of FY26. So Nomura, they see the NIFTY at 29,300.
Which is a massive jump from 22,800.
Huge. Goldman Sachs and Bank of America, they both see 29,000. And then Citi and the Reuters consensus are hovering around 28,500.
Yeah, the consensus is heavily skewed upward, but to keep it balanced, we should point out the cautious side too.
Fair enough, yeah. What's the bear case?
So Incred Equities put out a report with a base target of 22,850.
So basically flat from where we are now.
Right. And their bear case, if things really deteriorate globally, is a drop down to 21,029.
Okay, so that's the risk. But still, the heavyweights are targeting 28,500 to 29,000. Which brings me to the million-dollar question.
Let's hear it.
How do we get there? I mean, how do we get from a volatile 22,800 today, struggling to hold support, to a 29,000 target by December?
It's all about the earnings. The analysts synthesize the why behind these numbers very clearly. The street is leaning heavily on a recovery in corporate earnings.
Because 2025 was a pretty weak year for earnings, right?
Yeah, it was sluggish. But the projections for 2026 show a real bounce back, particularly in consumption and the financial sectors.
So companies are going to make more money.
Exactly. Plus, they expect those stable domestic flows to keep supporting the market.
But wait, earlier we said the PE ratio was around 20, which is fair value. Are these analysts expecting the market to suddenly become overvalued again?
No, and that's a key point. They emphasize, and the phrasing in the sources is very specific here. Analysts expect positive but moderate returns.
Positive but moderate.
Right. They aren't projecting a runaway euphoric rally.
Ah,
The growth to 29,000 implies upside from that raw earnings recovery. It does not rely on a major re-rating of the market's valuation multiple.
so the PE stays around 20, but because the earnings underneath it grow, the index point goes up to 29,000.
You nailed it. It's constructive, not euphoric.
Constructive, not euphoric. I like that. So let's bring everything together for you, the listener.
Yeah. Let's summarize the big takeaways.
The big takeaway from this whole stack of sources is that while the Nifty is currently wrestling with, global oil fears and high volatility, that solid domestic 8% GDP and the fair PE ratio act as a really strong floor.
It's a tremendous structural advantage.
Right. And the journey to the 28,500 to 29,000 range by the end of 2026, well, it obviously won't be a straight line, but the roadmap is clear.
It is. And practically speaking, for the listener, this means you don't need to panic at every daily VIX spike.
Exactly. Don't just watch the red ticker and stress out.
Right. You now have that bottom checklist to monitor. You have a broader context to actually understand the daily financial news instead of just reacting to it.
Yeah. But before we wrap up this deep dive, I want to leave you with a final, slightly provocative thought to just mull over.
Oh, I like where this is going.
Think about this. If domestic institutional buyers, those DIIs, the mutual funds, the local retail folks, if they have grown strong enough to absorb massive foreign sell-offs during a high-stress period with oil at $100.
A very high stress period, yes.
Right. What happens to the sheer force of this market when those external geopolitical pressures finally ease?
When the checklist actually turns green.
Exactly.
Yeah.
When oil cools down
Yeah.
and both domestic and the foreign money try to rush back into the Indian market at the exact same time.
The resulting squeeze could be, well, incredibly explosive.
It's the ultimate coiled spring. Definitely something to explore and model out on your own. Well, thank you for joining us as we unpack the mechanics behind all this market noise. Stay curious, keep an eye on that checklist, and we will catch you on the next deep dive.
Thanks for tuning in. See you next time.